And thank you so much for spending your time with us this lunchtime. My name is Min, and I'm the head of research at Endowus. Today, I have with me Joyce from UOB AM. Joyce is the head of Fixed Income Asia Singapore team, responsible for portfolios investing across global, Asia, and Singapore fixed income markets. She joined UOB AM in 2007 and has over 26 years of investment experience. She has also won multiple awards, some of which are as the most astute investors in Asian local currency bonds and in Asian G3 bonds by the Asset Benchmark Awards. She was also awarded the Benchmark Manager of the Year for Asia Fixed Income consecutively in 2017 and 2018. Under her stewardship, the assets under management for the United SGD Fund have grown significantly. Welcome, Joyce, and thank you so much for making time for us today.
Thank you, May, for having me. Good afternoon, everyone.
And now here we have to show some disclaimer slides for our compliance to be happy. And we'll just pause briefly so that you can take them in. We have disclaimer slides from both Endowus and UOB AM. Thank you. We like to keep the session as interactive as possible. And I know many of you watching us right now have many questions on what you can do in this rate cutting environment. Please go on Slido and add the Slido event code shown here, UOB AMFI, to post your questions. Joyce is a fixed income expert, and we're very lucky to have her today. So please do try to get all your questions answered by posting your questions. Next slide, please. I know many of you are familiar with Endowus, but for those of you who are new to us, Endowus is a digital wealth manager. Our mission is to empower all of us, from me to you to Joyce, to your family, your neighbors, your friends, to invest better so you can live better and sleep better at night. Our business model is very simple and intuitive. Our interests are aligned with yours. We get paid by only the access platform fee. We don't take trailer fees that are paid for distribution share classes. We give them back all to you. And where possible, we give you access to clean or institutional level share classes. Our investors are world-class firms such as UBS, Citi, you can see all their names here, etc. They trust us, and we hope that you will too. Next slide, please. We work with many well-known, reputable fund managers like UOB AM, and you can see all of them here, ranging from AIDS all the way to you. There are many that do invest in just public equity, but in the past couple of years, we also have formed partnerships with world-class private market investors and hedge fund managers, so we can provide you with access to strategies that were reserved in the past for just institutions or multifamily offices, single family offices, and the ultra wealthy. We want to do it as much as we can to democratize private market investing as well. Next slide, please. And now into the main topic for today. Since 2022, the Federal Reserve in the US has hiked the Fed fund rates aggressively. And this is because there was persistent rising inflation. I'm sure you have all seen that in the news. And this has led to many implications for investors trying to safeguard their fixed income portfolios. As you know, when interest rates go up, the prices of bonds will decline. It is a reverse relationship between interest rates and the prices of bonds. And you can see here on this chart, we have many different periods that shows the cut and then the hike and then the cut. So it's a cycle. And what we have seen is the US yield curve has inverted and then invert some more and just recently start to normalize somewhat. What do I mean by yield curve inversion? Typically, the yield curve is such that the yield rises from short term to longer duration or longer term. And when there's an inversion, it means that the yield for the short term is actually higher than the yield for the longer term. So that means you're getting actually paid less in terms of interest for locking in your money for a longer time. So that's a yield curve inversion. The negative returns that we saw for fixed income in 2022 have been scary, and the enticing high yields that were being offered for fixed deposits time deposits for money market funds, cash funds have all meant that investors are now over allocated into cash. And now that the rate cutting has started, we think, like many others, that there will be more to come. What should you do now? Next slide, please. Never fear, there are always other asset classes you can reinvest into. On this chart, we show how in the past 6 rate cut cycles, which we are entering into right now, global bonds have generally generated positive returns. But don't trust what I'm saying. We'll ask Joyce, who's the fixed income expert here, whether bonds are still attractive in this new environment.
Thank you, Mei. Maybe we go to the next slide. And before I begin, I'm sure many of us within looking into this live Zoom at the moment could also be waiting for the results for today's 6-month T-bills. If I could see your hand, I can imagine there are a lot of hands coming up. Or maybe some have already given up. Because if you look at it, the Singapore T-bills rate was as high as about 4% a couple of months back, or about a year ago. But where we are now, we saw a very rapid decline in the rate right now, and it's hovering at 3. I'm also waiting for the results later in the afternoon, but I presume it's likely to be below 3 for this coming week. So coming back to what Ming mentioned on the next slide, whether bonds still make sense for investors, I suppose a lot of investors should have different buckets of investments that you have placed your liquidity in. So some maybe in cash, some maybe in money market, and your decisions are likely to be based on considerations such as the stability of your valuation, of whether you will suffer a negative or will you gain in positive. And also the next thing to consider when you decide on your investments are likely to be your liquidity. When can I get the money? How soon can I get the money? And at what cost when I get back the money? And the next thing, of course, we are looking into investment, of course, for a yield. But of course, if you're looking into cash and fixed deposit, yield is likely to be low as for now compared to a year ago, which is like 4%. And the next thing, you will also consider that some investors may actually put in their money in money market instruments. So money market instruments basically is like a step up from your cash and deposits, where money market instruments are basically funds that buy into maturities that are up to a year. So in terms of stability, you may get a little bit step down, but with a 1-year durations, it's likely to be quite stable. And of course, liquidity is being notched a little bit lower as well, because unlike cash, you can always go and draw. Unlike fixed deposit, of course, you do not want to premature to uplift your fixed deposit, but due to circumstances, you can still walk into the bank and say, hey, I need my money back, and uplift your fixed deposit. Basically, you can get it on the spot. But if you buy into money market instruments, it may take a bit of time, maybe 2-3 days or so. So you do sacrifice in a bit of liquidity. But of course, money market do give you a little bit more in terms of yield. Because, for example, beside the United SGD Fund that I manage, I also manage the money market fund in UBAM. And for investors, retail investors, you get access to the 6-month treasury bills, which you can do today. But of course, you would have already submitted your participation 1 or 2 days earlier. But another space that money market is able to buy, unlike retail, is into the MAS bills. So MAS bills, I'm talking about 1-month maturity, 3-month maturity. And because these bills are only available for institutions like us, and therefore they trade more in line with the market rates. Unlike your treasury bills and maybe other influences, such as a lot of CPF money out there, comparing it to 2.5% as a base rate, so anything better than 2.5 is good for them. But for MAS bills, they tend to trade in terms of the liquidity that is presented in the market at the moment. So at the moment, MAS bills, the 1 month and the 3 months that is issued every Tuesday, do enjoy a higher yield compared to your cash or fixed deposit rate. Then, of course, as I mentioned just now, rates has come off a lot from 4% to 3%. And of course, you're wondering, ouch, it's kind of painful to be getting $4 in the past, and now I can only get $3. Where else can I go? So how do you step up? Let's look at the next slide. And coming back to what Min is saying, is why investment still relevant? It is even more relevant now, I would say. And of course, paying in fixed income, I would definitely promote this instrument. And also beyond that, I also do it for my own personal money. So of course, I'm not suggesting that all of you should transfer all your cash or all your money market into bond investment, but I suggest there's a space for it. But why is that so? For short duration bonds, okay, we want to focus on short duration bonds because we do not want to move on to any longer duration, because that will subject you to fluctuation and volatility because of interest rate movement. In terms of short duration, you get less impact from that. But what you have in exchange for that is that you get a better yield. So in this chart, you can take a look at the indicative yield. This one is dated in end of September. So we can see that fixed deposit rate is giving you about 3.2. But before I came into this live, I was checking what's the latest rate that my central dealers will be able to get. It's actually below 3 already. Then what about MAS bills? MAS bills, the last cutoff, as I mentioned, the MAS bills is oh no, this is 6 months. Okay, 6 months treasury bill, I'm sorry. So 6 months treasury bill I mentioned is, I'm taking a bet. Let's see how after 2 o'clock. It's likely to be below 3%, if not just marginally above. But you look at short duration fund. So what short duration fund means that for a portfolio that we typically buy up to 3 year for 3-year maturity in terms of bonds. So basically, I'll just buy bonds up to 3 year. So what's the advantage of having a 3-year duration bonds? Because I'm sure you feel the pinch for those who have been investing in MAS treasury bills. You ride the whole entire decline on rates. It was 4% a year ago, almost 4% a year ago. Now we go in 3%, slightly more, less than 3. So that itself is a very high reinvestment risk. That means if you're rolling every 6 months, you are confronted with the fact that all the uncertainty where your return will be for the next 6 months. But for short duration, basically for our fund in UBAM, which is called United SGD Fund, we aim to buy bonds up to 3-year maturity. So what does that mean for you? That means that whenever you buy into the fund helps you to lock in rates for the next 3 years. So of course, if you have been updated, I'm sure you are listening to market news, you know that we are at the peak of interest rate, and we're likely to see lower and lower rates going forward. So that is why it's very crucial for you to buy into a longer dated financial instruments that help you to lock into the rate of the rate currently that we are enjoying now. So if you look at United SGD Fund, now it's giving you about 3.73%. And if you have US dollar, if you are a US dollar based investor, in terms of US dollar deposit, you can get about 4.1 US Treasury 1 year. Now is about 4%. But if you buy into United SGD Fund, we also have a US dollar class that you can participate in, and that is giving you about 5.74%. So rounding back to your question, Ming, definitely bond is the way to go for now, and short duration bond. Thank you for that.
Thank you, Joyce. That was very, very insightful and helpful. I'm just looking at, just to summarize what you said, it's that there are different buckets of fixed income securities depending on an investor's time horizon and risk tolerance. Of course, the shorter duration you are, the lower the yield right now. And then as you go up, like you can see here, what Joyce is trying to say is that you can essentially perhaps get longer, higher yields for the longer duration part. And for those who are invested in treasury bills, what you'll have to do when it matures is to roll over your money into new treasury bills. But if you were to invest in a fund, a short duration fund, the portfolio manager is the one deciding where the opportunities are. And it could be not just in Singapore, but could be across different countries in Asia. And I'm going to actually turn to Joyce to explain how she's trying to get the best opportunities there are out in the region.
Thank you so much, Ming, for the question. Yeah, maybe I should elaborate a bit more about United SGD Fund. So, of course, unlike your MAS T-bills or even your fixed deposit, these are relatively safe in the sense that these are governments and banks exposure. So for United SGD Fund, we do buy into corporate credits. So corporate credits meaning it's like a loan, you loan it to the company for 3 years, and you expect to be paid back in 3 years' time. And definitely we are seeing opportunities there in terms that, we are earning that credit spread over your treasury bills investment. Yes, you do take a little bit of credit risk, but rest assured that precisely we are proposing for a short duration fund, because unlike you are trying to lend somebody money for 10 years versus lending money to somebody for 3 years, definitely you can see a better visibility if you are lending to the person for 3 years compared to 10 years. So that's how we are capturing the benefit of the opportunities within the short duration bonds in the universe. And the other thing I also want to mention about United SGD Fund, yeah, it's SGD Fund. Some may be a bit may misunderstand that this fund only buy into SGD denominated bonds. Yes, we do buy into them. Currently, is about a quarter of the portfolio are in SGD denominated bonds. And you may wonder, then what about the rest? So the rest of the 3/4, about half are in half are in US dollar denominated bonds, and the balance we are also exposing it to Japan denominated or even CNH China denominated, China renminbi denominated bonds. And I'm sure you're going to start to ask, wow, Joyce, then are there a lot of FX exposure? Am I subjected to FX volatility? Okay, rest assured. And precisely the reason why we call this SGD fund, because all the non-SGD denominated bonds are hedged back to SGD. So rest assured, there's no volatility in terms of FX. It's what we are getting at is only to enjoy the credit spread that we can get for you when you buy into this multi-currency denominated bonds. And of course, the next question you may ask, Joyce, why so complicated? Why don't you just buy into SGD denominator and make it simple for all of us? I hope I can. And actually, it's even easier for me to explain to you if the fund only buy into SGD denominated bonds, right? But there are a lot of opportunities out there in the US dollar bond market, in the Japanese bond market, and also in the China market. So for us, as we do this every day, every moment of me sitting here, basically to look at the best opportunity that I can find within the whole investment grade universe that I can bring better return for investors. And also, I also want to mention that this United SGD Fund is investment grade focus. So you do not need to suffer, you don't need to be worrying about, oh, Joyce, you're buying to corporate loan type of nature, then am I going to fear that these people may not pay back? So just for your information, year to date, I've been managing the fund for the last 17 years, and the fund is older than me. The fund is about 28 years. We never had any default case within the portfolio, not even restructured bonds. So just rest assured that we are getting your best value for you, the best opportunity for you, and also FX is managed and credit risk is also well contained. I hope that
Thank you,
clears
Joyce.
up.
Yeah, no, that was very helpful, I think. And you don't look a day over 28 for sure. Actually, we have a lot of questions on Slido, so maybe I'll just, bring out some questions for you to answer. You may
Sure.
have already alluded to the answer for this question, but this person asked, what is the preferred duration to lock in rates, given that 10-year is not as sensitive to cuts due to the steepening of the yield curve from deficit spending? Very technical question.
Sure. I'm sure this person is concerned about the volatility coming out from duration. So that's precisely the design for this short duration United SGD Fund. So basically, we are very stringent. We only buy up to about 3 years. So for example, this year is 2024. In the beginning of this year, I buy up to the maximum of a 2027 maturity bonds. So coming in a few months time, 2025, I will start to buy 2028 maturity paper. So in that sense, yes, there would be some bit of volatility in terms if there is any sharp changes in the interest rate. But having a short duration fund, you basically reduce your duration risk almost by a third if I compare it to a 10-year paper. I hope that helps to clarify.
Thank you. Now maybe we turn to geopolitics because there is a question on that. I think this person is worried about geopolitics. If war breaks out over Taiwan and US, if war breaks out over Taiwan and US decides to intervene, how would long-term US government bond yields react? They increase or decrease due to benefit from, the flight to safety.
Yeah, it's exactly to the point that I want to extract from the question itself, the flight to safety. So US Treasury is always deemed as a mode of safety. So whenever there's any form of crisis or any form of uncertainty, people will tend to fly to safety, which is US Treasury. And if there's more demand in US Treasury, rates will drop.
Okay, thank you for that. This one is actually kind of related to the previous question, but more so focused on Asia. Could you please talk about how the fixed income markets in Asia could be impacted by the rate cuts in the US? Why should we care?
Interesting question, but I'd like to maybe just keep it to Asia and only G3 currency bonds. So coming back to United SGD Fund, we basically buy into G3 currencies. So for if there would be any crisis per se, because bulk of the investment are in US dollar, so in terms of local rates changes, the fund will not be impacted because we only buy US dollar denominated bonds because these bonds could be issued by any country, any issuer in Asia, but because the bond is denominated in US dollar, it will only be impacted with changes in the US dollar rates. And of course, the other aspect, and if I can extend this discussion, is credit risk. So if there's really a war, people are in fear, people are wondering whether their business can weather through this crisis, then they're likely to be increase in credit spreads. So that increase in credit spread will reduce the valuation of our bonds, and then there will be a mark-to-market negative impact to that. But I would say that I have been in the industry for almost 30 years and managing the fund for 17 years. I always see such as opportunity to buy. Because as long as you've done your homework, and of course, bearing in mind that this fund buys into only investment grade issuers. So investment grade, typically, they are rated investment grade, meaning they can usually navigate difficulties relatively unscathed compared to possibly another non-investment grade high yield kind of issuer. So in that sense, the design of the portfolio is meant to be all weather, we may call it, where interest rate movements not likely going to impact a lot. Credit spread, not likely as well, but if there's credit spread widen, I'll be most happy to pick out any bonds there is that, because those will be cheaper. in terms of pricing for me. And I'll continue to ride on with that 3-year, and of course with the view that these issuers are likely to pay us back.
Thank you, Joyce. And maybe just for the sake of some of our audience who may not be as familiar with fixed income, could you explain G3 and could you explain credit spreads?
All right. G3, we basically mentioned about these are currencies that are international currencies that are kept as reserve currencies of central banks. I'm sorry if I introduce more jargons here, but basically the financial, all the country deemed as a central bank will keep it as reserve. So these currencies are US dollar, Japanese yen, euro. So these are the G3 currencies whereby these currencies are taken usually as a form of asset to hold in times of challenges. And coming to credit, as you mentioned, so of course, most of us will be familiar with government bonds. So government bonds, whatever rates that you get from government bonds, is MAS bill is giving you 2.97. We usually refer this to risk-free credits, risk-free. So you're getting risk-free return at about 3%. And for credits, there is a spread top up over a risk-free rate. And usually this can range at 50 or even lower for super high quality issuer, and can even go all the way up to very high. But of course, for short duration, United SGD Fund, we focus on investment grade. So the range is between 50 to 150. That is why for United SGD Fund, we are able to get a spread currently, as you see the slide, 3.73 over about 3%. That's about 70 basis point pickup. And that spread, the differences of between 3.73 and 2.97, about 70 basis point, that is what we meant by credit spread.
Very helpful. Maybe, speaking of conservative and investment grade and quality, there's a question, and our teammates have already answered this, but maybe just for the wider audience, I'll just ask you anyway. This person said, I need to invest in a fund that can preserve capital as I may need to use my savings for a down payment. Is Joyce's fund conservative?
Can I share an anecdote which touched my heart some years back when we was meeting up with investors? There was an investor who is planning for her estate, because she's given a timeline by the doctor. So she's planning how she will be able to find an investment like you for your down payment, something that is of certainty, something that she can pass on her inheritance to. So she picked United SGD Fund, and that is what she said. She think that United SGD Fund, given his track records, which you can view it in many open platform, it has delivered consistent return. And for the last 28 years, by calendar years, it has only done negative return in 2 years out of the 28 years. And you may, of course, ask, and what are the 2 years? The 2 years was back in the global financial crisis, when there was, I'm sure many of us will remember. And so spreads widened, rates were high, so therefore everything is like in the air. So those were difficult times where the fund went into marginal negative. The other negative return was back in 2022. Yeah, that's when interest rates was rising very rapidly, as what Ming highlighted just now, that you can see that the recent rate hike was very quick and a lot, precisely because of the inflationary pressure that the world economy was experiencing. Or maybe also like to correct myself, the fund has been for 26 years. Yeah. In the last 26 years,
long
only
track
2
record.
negative return. Yep.
Yep. That is very touching, and it's a really a testament that this person picked the fund. So thanks for sharing that. I have a question now that most fixed income investors hate, and this is why invest in fixed income when equities have higher returns? How would you respond to that, Joyce?
I have equity investment, I have fixed income investment, I have money market investment, I have cash investment. So all these investments should not be mutually exclusive. So while equity definitely give you the punch, 10%, 20%, or you talk about US stocks can go up by 50%, 100%, well, go for it. But I guess for fixed income, it is a space that is good for you because you can still get some reasonable returns, right? 3, 4, 5%, depending which currency you buy into. For Sing dollar, you can get about 3 or to 4. For US dollar, you can get up to about 5. And these are stable set of your total portfolio. So of course, unless you are super young and you think that you have 20, 30 years horizon, you want to put everything into equity, go for it. Yeah. But I think as a balanced portfolio, as a generic recommendation in your portfolio, I think most of the financial advisor that I come across, I think at least 20% in your investment portfolio should be kept in fixed income or more steady kind of investment, and maybe have up to 80% in your equity. So they shouldn't be mutually exclusive of each other. Both can exist together.
Yeah, very well put. And our client advisors here have responded as well to this question. It's really a matter of your objective, your risk tolerance, because equities can be more volatile, even though they have higher returns. So you just have to assess your needs and your objectives, and then you can come up with a portfolio. And at Endowus, we have client advisors here who can help you with that. The next question, I'm going to paraphrase this question. I think it's an interesting one. With more rate cuts on the horizon, would leveraged funds or funds with leverage benefit from the rate cutting?
Wow, I think a private bank friend to be in this Zoom live also. But I suppose you can. I mean, it sounds logical. If you leverage up, then rates go lower, and you sort of lock in your investment, say in United SGD Fund for the next 3 years. Certainly sounds very logical. I think so. But of course, fixed income being fixed income is our nature to be conservative. So if you're speaking about leverage, that means you will have to take that elevated form when there's volatility, and also taking the uncertainties of where rates will really go. Because in our market, nothing goes up or down in a straight line. There will be volatility, and it depends on where is your entry point, entry time. Yeah, so that is how I would think about that.
Yeah, I mean, leverage can be your friend, but it's also not your friend sometimes. It really depends. So be careful when you use leverage. This question talks about distributing class fixed income funds. I think this person is just asking about fixed income funds in general. Still holding short duration bonds, would most funds rotate to longer duration bonds given the interest rate cut?
Sorry, so what's the question?
I think would funds, fixed income funds in general, if they're holding short duration bond funds, would they rotate to longer duration bonds given the interest rate cut? I mean,
Yeah,
I guess the question is, if I may paraphrase, is should we expect to see funds becoming longer in duration?
yep. That's definitely a question for someone who is quite savvy in the market. So we, on this logic, if we know that rates are coming down, of course it makes sense for you to buy into higher duration bonds. Maybe I can share with you beginning of this year, when rates were a lot higher, we have already been buying into within the fund parameters, we're buying into 2027 maturity bonds. And of course, if you are talking about another fund that allows you to go even longer in terms of maturity tenor, you would have already done that as well. So for this fund, we have been doing that. And maybe just to share a little bit more, this year, compared to last year, as I mentioned just now, that the fund can buy up to 3 years. So back in 2021, 2022, as we know that rates were coming up, as we saw inflation just blew up after Russia war, and people returning and opening after COVID, things are not in order, supply chain is interrupted, your supplies, your prices are all going up, and we know that rates are going up then. So when rates are going up, then we have, for this fund, we've been buying very near dated bonds, 1-2 years. So after riding that high interest rate all the way up to beginning of this year, end of last year, or rather beginning of this year, we thought that rates will eventually come down because Fed has increased rate all the way up to 5.25%. And then inflation has showing signs. It went up to US inflation went up to as high as 9, and by then it has kind of sloped down to about 6%, and people are thinking that rates should be coming down. And then at the beginning of the year, the fund has really bought into the longest that we can extend, which is up to 2027. So definitely coming back to the question, it is certainly very logical. But right now, if you look at it, Fed has only cut once, 50 basis point back in September. Then our house is thinking that it will likely to cut another 25 basis in November, another one in December, making it a total cut of 1%. And next year, our house is thinking that there could be another 2 to 4 cuts. But eventually, we think that where it's comfortable is around 3.5 to 3.75 in terms of Fed rate. Yeah. So what you're looking at is that the best reference for Fed rate is the 2-year US Treasury. At one point of time, it went down below 3.5%. So market has moved before Fed. So market has done the job of Fed. So at where the rates is now is considered low. So maybe it is not a good time to switch into long duration bonds for now. Got to be very careful because market is sort of priced in perfection. So if you have been following market news again, last Friday, there was a shock to the market when US data was not as bad as most people imagine. And rates has corrected by about 20 basis points the last few days. And we are seeing 10-year back to 4%. There's almost a 40-50 basis point correction very quickly. So for now, I would say it's a bit more challenging. It's clearer in the beginning of the year when rates were super high. So how I will be managing United SGD Fund? Currently, we do have some flexibility because there are some buffer that I keep for the portfolio, around 10% in MAS bills. Remember that. So those can be quickly be sold and redeployed into corporate investment again. So opportunistically, which is in the last few days, I was buying aggressively because rates has rates has gone up, causing bonds to be cheaper, and I have been buying the last few days. So I guess now the question is not about whether we switch from short dated to long dated, but the opportunities I see is that before that market is in price with perfection, there will be some volatility because there are really a lot of uncertainties. The Middle East situation, or maybe people are wondering about will the inflation come back and bite us again. So these are, if all this element cause some volatility to the portfolio, these are opportunity for me to sell from my MAS bills and deploy back into the bonds if the bond price gets cheaper.
Okay. Yeah, and I
Long
mean,
answer to that question.
no, that's very helpful actually. But maybe just related to that question, there's another question that's asking for the impact of rates going down on a 30-year bond. And you've already kind of talked about it, how there is more uncertainty for longer dated bonds. And 30 years is a really, really long time. And of course, with longer duration bonds, like 30 years, they're more sensitive to interest rates, changes in interest rates. So I don't know if Joyce, you have anything to add to that, but I believe you've already answered the question.
Yeah, a 30-year bond, we always calculate the sensitivity using duration. So a duration of a 30-year bond likely lies in the area of 15. So whatever changes in the interest rate, you just multiply by 15 times. That will be the impact. So it's very mathematical.
And very large, actually, 15 times. That is quite large. So if so this question, and I know we're like at the 45-minute mark, so maybe we'll just take a few more questions. There are more questions coming in. So if interest rates are coming down, bond prices are already going up, is it too late to buy bonds?
No. I would say where the interest, yes, it has come down, but I feel it's likely to stay around here, which is still quite decent, right? 3.5 to 4% compared to 2 years, 3 years back. We only at one point of time my portfolio went down to just 1% yield. It's really miserable. I felt miserable then. So now it's at 3.5 to 4%, and it's quite decent, I would think so. So I would say, as just now as I alluded to, there's always a space for fixed income. So it's never late. Maybe just name you an example. It's just I also mentioned that because now rates has come down a little bit. What are the opportunities I see? I see a lot of opportunities in the cross-currency investment because just now I mentioned I can buy into Japanese yen, I can buy into say CNH. I can do a bit of arbitrage in that sense. Maybe just to name a recent trade I did, and I was kind of proud of it. I saw a HSBC bond that is maturing in 2026, US dollar. And I buy another HSBC bond maturing in 2026 also. But the one that I bought is in JPY, Japan, yen denominated. And with that switch, I get 50 basis point pickup for similar tenor, for similar or rather same credit risk, same structure. I get 50 basis point. So trust us, when you buy the United SGD Fund, we'll find our ways. There are pockets of opportunities. There is definitely for us to continue to be invested in fixed income.
Yeah, so it's really, again, going back to what Joyce said and what we've always espoused, which is really just look at your objective. We should not be trying to time the market because the rates will likely come down further. So it's not like we've seen the end. And also, you should be thinking more longer term horizon. What do you intend to achieve in the long run? And fixed income, there's always a part for in your portfolio for fixed income, unless you want to be very, very aggressive, then it's 100% equities and others. One more question, maybe Joyce, I think, and then we can just close the session. Is the 2% yield difference, because when you showed the bar charts between the SGD versus the USD United SGD Fund, primarily due to FX hedging costs?
Wow, definitely have a savvy audience there. Yeah, you're right. Currently, the hedging cost is around 150 basis point, 1.55%.
Yeah, we have very savvy client base as well. Okay, I think that's all I have. Would you like to add anything, Joyce, and maybe just as a closing remark, and then we can thank the audience and say goodbye.
Yeah, for me, maybe just speak for my own because I mentioned that I have cash. I don't have fixed deposit though. I have cash, I have money market, I have some United SGD bond fund myself. I have experienced the same thing as most people had. I bought into MAS bill 6 months. It was great, right? 4%, 3%. Then those are traded at a discount. After that, on that day, you get a refund back. It feels quite in Singapore colloquial, quite shook. You get your refund back up front compared to FD, you're gonna wait for maybe 3 months, 6 months down the road, only then you get your interest back. But as rates has come down, I was also thinking for myself, what do I do? And I do find myself buying the United SGD Fund now, switching out from treasury bills. So it's not a investment advisory here. I'm just sharing my personal investment decision here. So thank you for listening in, and thank you, Ming, for organizing this live, and thank you so much.
Thank you, Joyce. It's been a pleasure having you, and it's been really fun. And I love your insights, especially your personal into your like what you're doing for your personal portfolio. So thank you, our audience, for tuning in and spending your lunchtime with us. Again, if you would like to talk to any of our client advisors, you see all their pretty and handsome faces here. You can just scan the code or just go on the website and just chat with anyone. Thank you so much.
Thank you.